This is Matt Graham with the MVS Live market update. Last week was hotly anticipated and it did not disappoint. We were looking forward to this week for a few reasons. Number one, Treasury refunding announcement was expected to be a market mover. That's where Treasury announces auction sizes and overall issuance estimates for the upcoming quarter. And that was released in stages both on Monday and Wednesday. And it was responsible for kicking off the more serious part of the bond rally last week on Wednesday morning. It was joined by several economic reports that helped push the same narrative. First up was ADP employment at 113 versus 150. Modest miss, but an indication that NFP might have been slightly weaker than expected. Then we had ISM manufacturing. That PMI came in lower than expected. And also JOLTS, job openings and labor turnover. That was not lower than expected, but it wasn't too much higher. And it was also under the important 10 million level. And the bond market seemed to enjoy that trio of data and continue to rally into the Fed announcement in that afternoon. Fed announcement as expected, no hike. Nobody expected that. Fed Chair Powell reiterated things that multiple Fed speakers, including himself, said in the previous 3 weeks. And the takeaway for the bond market was essentially that the Fed could be done hiking, probably is done hiking, unless the economic data or inflation reaccelerate. And in that case, they would be willing to hike again if necessary. But in general, this is a shift and an important one from the September dot plot, where the Fed announced or forecast rather another 50 basis points of rate hikes and a longer time spent at the ceiling. The bond market subsequently adjusted 50 basis points or more higher in terms of bond yields. And now we have the Fed saying that, oh, hey, that 50 basis points we saw in September, we don't necessarily see that anymore. And so it is not a huge surprise that the bond market has rallied about 50 bips from the highs, a little bit less when you count the give back that we've seen so far in the current week, but nonetheless, it generally lines up. Rounding out last week's market movers, we had the big jobs report on Friday. It didn't miss by a huge amount, but it did miss, which was important. Non-farm payrolls came in at 150K versus 180, and the previous 2 months were revised down. Unemployment rate rose and the labor force participation rate dropped, meaning that the rise in unemployment is actually effectively a bit bigger than the headline would suggest. All that taken as evidence that the labor market is finally showing signs of legitimate cooling. Not that it hasn't from the frothy levels a year ago, but more so relative to a baseline from before COVID. So once we get into this sub 200K range, it is more in line with what the Fed wants to see before it feels comfy about cutting rates. Of course, inflation will need to play ball as well, but they believe that this modest softening in the labor market is a prerequisite for that. We'll see what we see as the year continues to a close over the next 2 months and as data continues to come in. It's likely the case that a big picture confirmed shift in rates will require more than a single week of favorable economic data. And one could argue that last week's data isn't really quite bad enough to cause a shift. So we have to consider that some of the reversal in the bond market could be due to just how crappy and high the rates were coming into last week. Could be the market blowing off a little bit of steam. Indeed, when you plot a trend line under the higher lows leading up to last week, the big rally seen on Wednesday, Thursday, and Friday merely got yields back in line with that upwardly sloped line. So we will need to see more gains to defeat that trend. It's not impossible. And I would go so far as to say it could even be likely that we've seen the highs for this cycle as long as economic data doesn't reaccelerate or show new signs of resilience. As long as inflation continues to do what it's been doing, then the highs are in. Otherwise, if the data pops, it would not be too hard or too surprising to see yields re-challenge the ceiling. But all we really know at any given time in the bond market is that we're good for now. And now we have the current week to talk about really quickly. There are a ton of Fed speakers, hardly any economic data, and 3 big Treasury auctions for the market to digest to see how investors are feeling, not so much about the increased amounts of these auctions, but more so about the recently lower yields that have been, changed dramatically from where they would have been had these auctions been held a week ago. So that will be the most informative thing from a bond trading standpoint. And then the Fed comments are really peppered throughout the week, and those could help sort of provide the fine-tuning adjustments, if you will. That's going to do it for this week. Back to you.